fear. It is the one constant in finance. Whether it's people literally lining up outside a bank in the 1930s or frantically tapping on a crypto app today, the emotion is exactly the same. It's that desperate race to get your money out before it's all gone. So today, we're going to dive into how financial systems, both old and new, are being re-engineered to manage that very primal financial instinct.
So let's just start with this question right here. I mean, on the surface, you'd think they are worlds apart, right? One is all brick and mortar, physical cash. The other is just pure code living only on the internet. But underneath it all, they share the exact same vulnerability.
And that vulnerability? It's called a liquidity run. It's this terrifying feedback loop. You withdraw because you think others are going to withdraw. Then your withdrawal makes other people nervous, so they start to withdraw. And just like that, it becomes a self-fulfilling prophecy, a panic that can bring down even a totally solvent institution. This is the fundamental problem that everyone everywhere is trying to solve. Okay, first up, let's look at how traditional finance, or TradFi as people call it, has dealt with this for decades. Their approach historically has been all about building defenses, strong, kind of rigid structures designed to just halt a panic right in its tracks. And what's so interesting here is just how literal these defenses are. I mean, hedge funds use tools like lockup periods, where you simply cannot touch your money for, say, a year or more, or gates, which basically cap the amount of money that can leave the fund in any given quarter. These are, for all intents and purposes, hard walls designed to stop a run cold. But just building walls? Well, that has its own problems. It can really shatter investor confidence. So a more nuanced idea started to emerge. What if you could act more like a break than a wall? What if you could actually manage the panic by making it less profitable to be the first one sprinting out the door? And this brilliant analogy from a recent Yale School of Management paper just captures the idea perfectly. Think of redemption fees not as some kind of penalty, but as a congestion charge, right? When everyone tries to exit the city at 5 p.m., you get a massive traffic jam. But if you charge a little more to use the highway during that rush hour, you can smooth out the flow. Well, turns out the exact same principle can be applied to money. So this is the classic system, what researchers call sequential service, and it is a brutal first-come, first-served model. The first people in line get 100% of their money back. But once the easy-to-sell assets are gone, the latecomers, they might get absolutely nothing. This creates a huge incentive to be first, which is the very thing that fuels a panic. Now, let's see how you build a better system. This is what's called the fee-to-queue model. So here, once withdrawals pass a certain point, a small fee gets charged. But here's the really clever part. That fee money is immediately used to pay more people waiting in the line. So instead of the first group getting 100% and everybody else getting 0, more people get paid, maybe say 95%. This dramatically reduces that fear of a total loss. And this illustrates maybe the most powerful mechanism of all, the fee to unpaid. In this model, the fees collected from all those people rushing for the exit are actually given to those who choose to stay. It directly rewards patience and it punishes panic. You're no longer just trying to avoid being last. You now have a positive financial reason not to run at all. So the key takeaway here is that you can use financial engineering to directly change human behavior during a panic. Okay, so let's pivot. Let's jump into the new world of decentralized finance, or DeFi. It doesn't have bank tellers or fund managers, but believe me, it has its own hyper-fast version of a bank run, and it's all driven by something called mercenary capital. This quote just gets right to the heart of the problem. In the early days of DeFi, projects needed liquidity to even function, so they offered these insane rewards. We're talking sometimes thousands of percent in annual percentage yield, or APY, just to attract it. But the capital that showed up was completely transactional. It had zero loyalty. And this created this incredibly vicious, destabilizing cycle. A project would launch, offer these huge rewards, and capital would just flood in. But the investors, the farmers, would immediately sell the reward tokens they earned, putting massive downward pressure on the token's price. Then, as soon as the rewards start to dip even a little, that same capital would flee overnight, leaving the project totally high and dry. It's a digital age liquidity run on steroids. So the core problem was exactly the same as in traditional finance, a complete misalignment of incentives. And so DeFi innovators started asking themselves, what if we could write new rules? What if we could actually program loyalty directly into the financial code itself?
And the first huge idea was something called Protocol-Owned Liquidity, or POL, pioneered by a project called Olympus DAO. The insight was simple but really profound. Instead of endlessly renting liquidity from mercenaries with these inflationary rewards, why not just own it? Through a cool mechanism called bonding, the protocol basically buys the liquidity from users, making it a permanent part of its own treasury. It's a huge shift from a temporary, super expensive solution to a permanent, sustainable one. Okay, so owning your own liquidity is a huge step forward, but you still need to align the incentives of your token holders. I mean, how do you get them to think like long-term partners instead of just short-term speculators?
Well, this leads to the awesome concept of V-tokenomics, which stands for vote escrowed. The idea is actually pretty simple. The longer you're willing to lock up your tokens, the more power you get. So let's say Alex and Bob have the same number of tokens, but Bob locks his for 2 years, while Alex only locks his for 1. Well, Bob gets double the voting power in governance and a much larger share of the protocol's rewards. It just elegantly aligns power with long-term commitment.
So we've got owning liquidity and programming loyalty. But what if the system could be even smarter? What if the defenses could react automatically and dynamically to changing market conditions, all without any human needing to flip a switch?
This is the promise of new features like the upcoming hooks in Uniswap V4, which is a major decentralized exchange. The easiest way to think of them is like programmable plugins for finance. A liquidity pool can be programmed with a hook that automatically increases trading fees whenever volatility spikes, protecting the people providing the liquidity from losses. Or a hook that automates really complex management strategies. It's like building those dynamic congestion charges we talked about right into the financial highway itself. All right, so we've seen the old guard's playbook of walls and breaks, and we've seen the new guard's playbook of programmable incentives. So what happens when we start to bring these two worlds together? Let's go back to that Yale research for a second. This right here is the proof in the pudding. That vertical axis shows the probability of a panic-based run. The blue line is the old first-come, first-served system, and you can see it has the highest chance of a panic. Now look at the red and green lines. Those are the systems with dynamic fees. The crucial point is that they are dramatically lower across the board. The theory actually works. Smart fees, those congestion charges, really do reduce the incentive to panic.
So yeah, we've looked at two very different worlds here. One is built on centuries of regulation, legal contracts, and human managers. The other is built on open source code, smart contracts, and algorithms.
But for all their differences, and this is the amazing part, they are converging on the exact same lesson. To create a stable financial system, you have to solve for human psychology. You have to design rules, whether they're legal rules or rules made of code, that align the short-term, self-interested actions of individuals with the long-term health and stability of the entire system.
And all of this leaves us with the really big question. As these two worlds continue to learn from each other, what is the future of financial stability actually going to look like? Will it be top-down, enforced by regulators? Or will it be bottom-up, embedded in transparent code? Or, what's probably most likely, is it going to be some kind of hybrid of the two that we can't even imagine yet?